If every part of your setup lines up perfectly, you mark your order block, you set your position. But the market refuses to mitigate your zone and moves without you. The reason behind this problem is explained in this lesson. Section 1. The real reason your order block does not get mitigated. Most traders focus only on drawing an order block, assuming that every zone the market creates must be revisited. But smart money does not treat all zones equally. Some order blocks are created only to build early positions, while others are created to finish accumulating, break structure, and confirm the continuation of the trend. This is where the true distinction begins. There are two types of order blocks. 1. The extreme order block. 2. The decisional order block. Understanding the difference between these two determines whether the market comes back for a deep mitigation, or it respects a shallow zone and continues without returning. If you choose the wrong type, the market returns to the extreme while you entered from the decisional, or it mitigates only the decisional while you wait for a deep pullback to the extreme. It is not that the market ignored your zone. You simply picked the wrong type of order block for the phase of structure. Now that you understand why not every order block gets mitigated, let's look at what the extreme order block actually is. Section 2. What exactly is the extreme order block? The extreme order block is the very origin of the entire move. It is the first zone where smart money begins entering the market, but not where they finalize their position. Key characteristics. 1. It represents the initial intention, not the commitment. Smart money starts building early orders here, but they are not ready to push the trend yet. 2. It creates the first displacement, but does not always break structure. The move from the extreme shows direction, but not confirmation. 3. It often remains unmitigated for a long time, because smart money may not need to return once price moves away. 4. It sits at the deepest point of the swing. This is why deep pullbacks target it, and shallow pullbacks ignore it. The extreme order block is the start of the story, but it is not always the zone price wants to return to. Now let's move on and break down what the decisional order block truly is. Section 3. What exactly is the decisional order block? The decisional order block is the zone where smart money makes the final decision to commit to the trend. This is the most important and most reliable order block in the structure. Key characteristics. 1. It forms after the extreme order block. This is where smart money completes their accumulation. 2. It is usually shallower than the extreme order block. The market respects it more frequently and with less retracement. 3. It has the highest probability of mitigation. The market often returns to rebalance price or refine positions. 4. The best way to identify it is to locate the zone where the final opposing order block flips. In a bearish move, find the last bullish order block that flips bearish before the drop. In a bullish move, find the last bearish order block that flips bullish before the rally. This flip is the true cause of the break of structure and confirms smart money's real commitment to the trend. Now that you clearly understand the decisional order block, let's move to the next section and review a few real chart examples. Section 4. Real chart examples. Identifying the decisional order block in action. To make a concept absolutely clear, let's walk through a few real chart scenarios. Example 1. Bearish scenario. Price is in an uptrend and creates a bullish order block. The next move fails to create a higher high and instead grabs liquidity above the previous high. Then the market strongly reverses and breaks the previous low. Before this drop, the final bullish order block is violated and flips bearish. That flip zone becomes the decisional order block. What happens next? Price pulls back to this flip zone, mitigates it precisely, and then continues falling, confirming smart money's bearish commitment. Example 2. Bullish scenario. Price is trending downward and forms a bearish order block. A liquidity sweep occurs below the previous low. Price reverses aggressively and breaks the previous high. Before this rally, the last bearish order block gets broken and flips bullish. This flip zone becomes the decisional order block. What happens next? Price returns to this zone with a controlled retracement, mitigates it, and then launches upward, continuing the new bullish trend. Now that you understand the difference between the extreme and the decisional order block, the next step is learning which one you should actually trade from in live market structure. In the next lesson, I will give you a clear and practical framework that shows you exactly how to choose the correct order block every single time. So make sure to watch the next video. And do not forget to like the video, leave a comment, and subscribe to the channel for more smart money education.